Artificial intelligence is being described as the most important technological breakthrough since the internet. Every week, headlines announce new AI models, billion-dollar investments, and companies racing to build smarter systems capable of transforming nearly every industry. To many investors, it feels like the beginning of a new economic era. But beneath the excitement lies a question that rarely receives the same attention. What if the AI revolution is being powered not only by innovation, but also by an enormous amount of borrowed money? Building modern AI is incredibly expensive. Training advanced AI models requires vast computing power, enormous data centers, thousands of high-performance chips, and highly skilled engineers. These projects often cost hundreds of millions or even billions of dollars before generating meaningful revenue. Unlike many traditional software businesses, AI companies must continue investing heavily just to remain competitive. Every improvement requires more hardware, more electricity, and more capital. To support this rapid expansion, technology companies have spent unprecedented amounts on AI infrastructure. Global investment in data centers continues to reach record levels, while startups regularly raise funding worth billions of dollars despite having limited profits. Investors remain willing to finance these ambitious projects because they believe AI will reshape the future economy, but belief alone does not pay the bills. For more than a decade, companies benefited from one of the cheapest borrowing environments in modern history. Following the global financial crisis, central banks kept interest rates extremely low to encourage economic growth. Cheap money allowed businesses to borrow aggressively, investors to take larger risks, and technology companies to prioritize growth instead of profitability. During this period, raising billions of dollars became significantly easier than it had been in previous decades. Artificial intelligence emerged at exactly the right moment. As excitement around machine learning accelerated, investors poured unprecedented amounts of capital into the industry. Companies competed to build larger models, faster chips, and more powerful cloud infrastructure. Instead of focusing on immediate profits, many businesses concentrated on capturing market share, assuming future earnings would eventually justify today's enormous spending. History shows this pattern is nothing new. Nearly every major technological revolution has experienced a period of intense financial optimism. During the railway boom of the 19th century, investors believed railroads would transform global trade. They were right, but many railway companies still collapsed because construction expanded faster than profits. The same happened during the dot-com bubble of the late 1990s. Investors correctly predicted that the internet would change the world. However, many internet companies failed because they burned through cash long before building sustainable businesses. The technology survived and reshaped society, but countless investments disappeared along the way. That historical lesson matters today. Revolutionary technology does not automatically create profitable companies. Investors often mistake technological success for financial success, even though the two are very different. A brilliant innovation can still become a poor investment if costs continue rising faster than revenues. Today's AI industry faces similar challenges. Building increasingly advanced systems requires enormous computing resources and continuous investment. Companies fear falling behind competitors, so they keep spending at extraordinary levels. The race to develop the next breakthrough has become as much a financial competition as a technological one. At the same time, the financial environment has changed dramatically. Inflation forced central banks to raise interest rates, making borrowing far more expensive than it was only a few years ago. Companies that once depended on cheap debt must now pay significantly higher financing costs. Investors are becoming more selective, demanding clearer paths to profitability rather than endless promises of future growth. This shift could have consequences far beyond Silicon Valley. Pension funds, mutual funds, banks, suppliers, and manufacturing companies all have financial exposure to the AI industry. Data center construction supports thousands of jobs, while semiconductor manufacturers depend heavily on growing AI demand. If investment slows sharply, those effects could spread throughout the broader economy. None of this means artificial intelligence is destined to fail. AI has enormous potential to improve healthcare, automate repetitive work, accelerate scientific discovery, and increase productivity across countless industries. The technology itself may become one of the most valuable innovations of the century. The real question is whether every company investing billions today will eventually earn enough to justify those investments. History suggests the answer is probably no. Every technological revolution creates winners and losers. A handful of companies often emerge as dominant leaders, while many others disappear through bankruptcy, acquisitions, or declining competitiveness. Investors sometimes underestimate how difficult it is to build a profitable business in rapidly changing industries. Perhaps the biggest lesson is that debt is not inherently dangerous.